Today, my name is Chris Rule. Just a brief introduction. I represent the Coreshares Asset Management business. We are a passive asset management business, which means that we manage everything within a rules-based environment, and we have ETFs, unit trusts, and we manage money for larger institutional clients. So today I'm going to be chatting to you specifically about two of our global ETFs, which we are launching on the 4th of November. And for now, we're running a book build, which means you as the clients get to participate and invest without paying any brokerage, which is great. And EasyEquities is going to take part in this book build. They've mentioned to me that they will be emailing out an email later this afternoon to inform you guys exactly how you partake in that book build. So you can expect that if you're an EasyEquities client this afternoon, but they will be partaking in the book build. So thanks again for your time and sorry for the wait. I'm going to try and go through this. I understand that time is of essence now, as quickly as possible. So quick introduction into Coreshares. Coreshares, as I mentioned, is a passive asset management business. We run 8 ETFs on the JSE currently, with over 10,000 clients in those ETFs. So, we are really committed to bringing low-cost products, which are transparent and which have accurate tracking of the indexes that we plan to follow. So that's Coreshares. In terms of who owns us and some of our corporate backing, we're quite a new brand on the block. Although I've been involved with the business for 5 years, and quite a few of my colleagues as well. So we're not new to this business. It used to be called Grindrod ETF business. We recently rebranded because we took on some new exciting corporate shareholders. So Rand Merchant Investment Managers are a shareholder in our business, and so are Yellowwoods Capital along with Grindrod. Yellowwoods Capital, if you're not familiar, have shareholding in Hollard, Clientele Life, and a few other large financial services businesses. So let's get down to business. Today we've come to chat to you about our 2 new global ETFs, which we will be launching on the JSE, as I mentioned, on the 4th of November. But you guys can invest before that without paying brokers by participating in the book build. So the first ETF I'm going to chat about is the Coreshares S&P Global Property ETF. So really what this is it's an exchange-traded fund which trades on the JSE and effectively gives you exposure to the world's largest offshore or property funds. And really the beauty of this is you can buy it on your home market in rands and get exposure to a global pool of underlying funds. So exactly as I'm sure you're all familiar with, what an exchange-traded fund is it's a pooled fund where by buying one share, you get access to multiple shares. In this instance, you get access to 40 underlying global property funds. So why include global property in your portfolio? Really, it's exposure to blue chip offshore, to the blue chip offshore commercial property sector. There's great diversification benefits when you include an investment like this in your portfolio, both from an underlying company's perspective, but also from a rand hedge diversification benefit. So at the bottom of this page, what you're going to see is you're going to see 2 graphs which compare this global property index, which our ETF tracks, and I'll touch on some more detail on that, to our local property index. So basically what we're showing is the relative size of this global property index versus the local JSE SAPI index, and really a 10.8 trillion rand market cap versus the 350 odd billion rand market cap of our local property sector. So really a huge market in comparison to our local market, and really the largest, most liquid listed property companies globally. So how does this investment work? Well, we track an index, and when I'm talking about tracking an index, we actually buy all those shares that are in the index, which is run by S&P Dow Jones. It's the S&P Global Property 40 Index. And what they do is they start with all listed property companies on developed exchanges. So they've got a starting universe of some 809 listed property companies. And then quite simply, they select the 40 largest across the world. And on top of that, there are a few what I call common sense filters. So no company can exceed 10% of the portfolio. If a company has not paid a dividend in the last year, it will be excluded from the portfolio. And if there are negative earnings in the previous year of that company, it will also be excluded from the portfolio. So a few, as I said, what I call common sense filters to exclude any unlikely events. A perfect example of how the 10% cap works would be in our top 40, the local top 40 index at the moment. Naspers is around 20% of that portfolio. So if there was a cap there, it would cap Naspers at 10%, and then the rest of your money would be distributed across the remaining 39 shares. So really a good risk management tool to reduce your exposure to some of those global to a single stock in your portfolio. So how does this look when we have a look at the global footprint? And I'm going to be chatting about a couple angles. Well, most of this portfolio sits in the USA. Over 55% of this portfolio is USA specific. And then following up with that is some Eastern exposure, 11% in Hong Kong and 14% in Japan, to name a few of the significant geographic exposures. So now this is great for the JSE. If you consider some of the global listed property companies we have trading on our markets, the likes of Capco and Inchu, the likes of NEPI, and so on and so forth, and Polski, all of these, although offer great offshore exposure, are very specific from a geographic perspective. So Capco and Inchu, and more recently Hammerson, all offer you primarily UK property exposure, or only UK property exposure. NEPI offers you primarily Eastern European exposure. So even though our JSE, our local JSE, has almost 35% of its local property market is offshore, it's very specifically in the UK and in Eastern Europe, with the exception of Rockcastle, and I'll chat to that a bit later. So this is a great opportunity to get what we are calling genuine global diversification. So exposure to the world's largest property markets, of which the USA is that. So let's have a look at the next slide, because not only is it geographically diverse and significantly different to anything that's available on the JSE, with the exception of Rockcastle, and I'm going to chat to that in a few seconds, but it's sectorally diverse. So what's really interesting about this portfolio is it offers you diversity across sectors. So you get, in the offshore market, you get really specific property companies. For example, you get healthcare real estate companies. You get office-specific real estate companies. Whereas most of our local listed property companies are diversified REITs with large weightings in the retail sector. So both, diverse from a geographic perspective, but also from a property sector perspective, which for an investor is really encouraging. And on the right, you can see some of the top 10 constituents. So most of these, as is a knock-on of that geographic breakdown, are US specific. But outside of the US, you get Unibail-Rodamco, which is a well-known French REIT, and Mitsubishi Estate, which is a really well-known Japanese REIT. So great global blue chip property exposure. Now, in terms of how you as investors are going to look at this global property ETF is in one of two ways. The one way would be to say, well, let's compare it to some of the global options that are available on the JSE at the moment. So as I mentioned earlier, you have Capco, etc., and most of them offer you specific exposure to the UK and to Eastern Europe. In fact, if we look at the local index, which has some 35% offshore exposure, 19% of that is Eastern Europe specific. So you really are picking up really specific exposures when you're investing on our local markets. So this is a great diversifier. So you could look at it as replacing some of your Capcos, Intus, and Rockcastles and so on and so forth to give you genuine broad diversification, or you could think of it as a complement to some of those holdings, where you would hold this in a basket of shares with a Capco and Intu or one of those other shares, and this the Coreshares Global Property ETF really offers you a great complement and genuine global diversification. Relative to Rockcastle, who holds some US exposure, the beauty of exchange-traded funds is they always trade at net asset value, which means you're always buying this ETF at fair pricing, whereas a company like Rockcastle can trade at significant premiums and does trade at significant premiums. So that trades at a close to 200% premium to its underlying valuations of the listed property companies they buy. And that's the beauty of exchange-traded funds, is that they are transparent, that they always trade at fair pricing, and so on and so forth. So that's the one way to look at this. The next way to look at it is relative to some of our local asset managers managing global portfolios. And really the age-old passive argument, wherein active managers, to be frank, really struggle to outperform passive benchmarks. And this is no different. So these are all the available global real estate funds in South Africa. And as you can see, not only are they significantly more expensive, so we plan to bring this in, this particular ETF, this Coreshares Global Property ETF, at a fee of between 0.55% and 0.65%. The next cheapest fund available is at 1.3%. So really significantly cheaper. And if you have a look at the performance on the top, which is annual performance in Rand, so that's what your experience would be as an investor of the index. So for the fund, you would expect to underperform that index by about the TER, which is what I was talking about, that 0.65%. So you can see that the managers really struggle to keep up with this index. And even if you did take off, let's say, 1% off the index for costs, which is very generous, as you can see, our cost is going to be around 0.55%. You still tend to outperform these managers over most periods. So really, we think a great product and has a lot to offer for you as investors in terms of gaining global exposure on our exchange. So you get two kinds of exposures when you invest in this. As I mentioned, you get the sectoral exposure, and you get both the currency exposures of these markets plus the underlying property companies where you get exposure. So we really think it's a great product, and we're pleased to be able to bring it to the JC. It's the first of its kind on the JC. It's the first global passive property tracker. So we looking forward to launching it, and we hope you guys will participate in the book build. In terms of questions and so forth, I'm going to be taking some questions after we've gone through it. It tends to be easier to do so if we do that. So if you have any questions, please let me know. And I'll go through some of the high-level stuff again after I've gone through the next ETF. So the next ETF we're bringing to market is the Coreshares S&P 500 ETF. This index almost needs no introduction. You will be familiar with it. It's probably on the radio every evening and so on and so forth. But here it is. It was created in 1957. It's the first index that a fund was ever created on the back of. It has a total market cap of over 270 trillion rand versus our JC of 15 trillion rand, so significantly bigger. And really what it is it's giving you access to America's largest listed corporates. And as you know, America is, of the world index, makes up some 55%. But a few observations, as the index says, it's the top 500 companies on the US. And a few observations which we think are quite interesting from this index perspective. And those are that, this S&P 500, let me go through the index quickly. It's very simple. Effectively, it's the large cap US index, and you're invested in a float adjusted market cap. Float adjusted just means that if a company is held by another investment company, let's take a JSE example, like Capitec, who's owned 30-odd% by PSG. If it had a total company size of 100 billion, 30% of that would be excluded from the index because it's already held by another company, PSG. So it really avoids double counting in the index. So your 500 largest companies, but what I was touching on, which is an interesting observation, is this is no longer just a USA specific play when you're investing in this. Sure, you're investing on the US markets and you're getting US dollar exposure, but if you have a look at where these companies are generating their revenues, they are certainly it certainly is a global investment product, where some 44% of revenues are generated outside of the US, which is quite significant. So if you think of some of your global heavyweights which are in here, some of the top holdings, your Apples, Microsofts, Johnson & Johnson, so on and so forth, these are companies which have global footprints. So yes, you're getting US dollar exposure and you're investing in the US markets, but what's great is that you're getting a global investment portfolio. So that's the one angle. Is this, even though it is a US fund, is certainly a global theme and a global mandate. Another interesting observation relative to some of our local markets, and as you're aware, I'm sure, the JSE has really a lot of rand hedge stocks. And the top 8 of our top 40, majority of those are genuine rand hedge stocks. But the difference between buying a rand hedge stock on the JSE or buying the Coreshares S&P 500 ETF on the JSE is this offers you genuine rand hedge. It offers you genuine diversification, whereas some of all of, in fact, the listed JSE companies like British American Tobacco and so on and so forth, they offer you genuine rand hedge properties, but you're taking on very much company-specific risk. And to be honest, you've got a very limited opportunity set in terms of the rand hedge stocks on the JSE. So this is a great opportunity to be able to invest through the Coreshares S&P 500 ETF into the likes of Apple, who is the biggest weight in the portfolio, Microsoft, ExxonMobil, Amazon, Johnson & Johnson. Just to name a few, these are our large, globally the biggest companies in the world, and really offers you an opportunity to participate in this market. So different to our rand hedge stocks where you've got company-specific risk, here you're holding a basket of 500 shares. So you've got really a broad diversification in that instance. Also, when you're looking at some of the sector biases that sit on the JSE, what's great about this S&P 500 index is it offers you a different kind of sectoral exposure. So if you have a look at the top 2 largest sector weightings, these are information technology and healthcare. Those are sectors which we are significantly underweight on our index. Now, I'm sure a lot of you are thinking, well, we've got 20% IT effectively on the JSE because of Naspers, but that's really, again, single stock exposure, whereas here you're getting 20% of your portfolio in really the world's giants in the IT sector: Apple, Microsoft, Amazon, Facebook, so on and so forth. And then what's even more interesting is that the healthcare sector is the second largest sector. On our JSE, we seriously underweight healthcare, and makes up around 4-5% of our index. So really a nice opportunity to diversify yourself, not only in terms of the makeup of the underlying funds and the rand hedge component, but sectorally we've got very different exposures to what's currently available on the JSE. So really that's the one angle, is to look at it relative to other shares, because this sits as a share in your portfolio. And perhaps if you're worried about those single stock exposures, but you like the rand hedge diversification, this is an option. But the other way to look at it is to look at it relative to other funds which manage global mandates, equity mandates from South Africa. So these are some of our big asset management companies who have a global unit trust or a global strategy, and the readings are not dissimilar to that of the property fund, where the cost is significantly lower. If you look at our Coreshares S&P 500, again, exactly in line with the property fund, we are going to be coming in with a TER of between 0.55% and 0.65%. If you look at the next, or the average at least of the global general equity funds at 2%, we're cheaper by some 1.5%. So really a lot of benefit there. And as you can see, all those costs you're paying up for, you're really not being compensated for in terms of performance. So the performance of these funds, as you can see at an aggregate, and we're looking at the red bar chart, you'll see over all periods they significantly underperform the index. Again, this is an index, so to be generous, let's take 1% off all those returns, and you still have significant underperformance of the active universe. Now, I said take off 1%, and that's a very generous allowance. We should be taking off, let's call it 0.65% or 65 basis points annually. So much cheaper, and the performance speaks for itself really in this index. The bottom right shows you standard deviation of the index versus the active managers again, and which is a measure of risk or variability of returns, and again that's very similar to the active managers. So really the class of passive story, and that's the S&P 500. As I said, doesn't really need an introduction. A lot of global thought leaders have been weighing in on their thoughts around this fund. Warren Buffett has famously said that that he recommends that the trustees of his family wealth one day is put 90% into an S&P 500 fund and 10% into short-term government bonds, or effectively cash. So, guys like that weighing in on the debate, weighing in on the topic, and really putting some of their weight behind this kind of investment. So those are our two ETFs. I'm going to go through some of the details of the funds, the costs, the distributions, all that kind of stuff, some of the role players, just to give you guys some comfort. And then we'll be taking some questions. Sorry, I did rush through that a bit, but I'm very wary that we started a bit late and you guys have to get back to work at some stage. So let's recap on the Global Property Fund quickly, the Global Property ETF. 40 largest property companies in the world, large US weighting, which complements nicely with some of our locally listed property companies. We're going to be paying out distributions semi-annually. These funds are regulated by the FSB in terms of being a foreign collective investment scheme. They're also regulated by the FSC in Mauritius, which is their FSB equivalent. And then, of course, the JSE regulates these as the exchange. And we got permission from the Reserve Bank in terms of externalizing the money. So really well regulated, robust instruments. In terms of you as an individual, these do not qualify as foreign assets in terms of your annual allowance of externalizing money. So in other words, you can use this as part of your rand money and get global exposure. The ETF, as I mentioned, will trade on the JSE starting on the 4th of November, but is available in the book build. So those are some of the salient details of the Global Property ETF. The S&P 500 ETF, as I said earlier, the strategy needs no introduction, but it's the 500, let's call it, largest companies on the American Stock Exchange. We're paying out distributions semi-annually, just like the Global Property ETF. S&P 500 ETF is regulated by the FSB, the FSC, and the JSE and the Mauritian Stock Exchange. Again, it doesn't count as your foreign exposure in terms of Regulation 28 and in terms of your personal allowance to externalize money. So it's seen as a local asset, although it does reference foreign assets. And very importantly, before I move on, these are both exchange-traded funds, which means that there's no risk to Coreshares in terms of credit risk of the underlying performance of these funds. They're very different to exchange-traded notes. So these funds, all of what we do is we effectively collect cash and then we invest in those underlying companies which I showed you earlier. So we literally go and buy those companies on those exchanges and we hold them custody with our custodian. I'm going to just jump one forward, who is Societe Generale, which is a global custodian. So when the money moves in South Africa, it goes straight to SocGen, who holds it custody. It then moves into their global custodian account, and they literally hold those shares ring-fenced away from Coreshares. So in other words, there's no solvency risk to Coreshares, and these are most certainly funds and not notes. So I know that's become a bit of a hot topic recently, and really important that we make that clear. Some of our other role players in this, Coreshares is obviously the asset management company. The issuer is Coreshares Global Investments, and there the regulators are that I chatted about. Deloitte's doing the audit, Norton Rose is our legal advisors. So really we've tried to put together a robust structure here, which is safe and user-friendly for clients. I'll touch on the market making now. I just want to hop back. The timetable for the listing of these products. Well, you can already start putting your applications through to EasyEquities in terms of the book build. As I said, the primary advantage for you as clients participating in the book build is that you forego the brokerage of buying it through the JSE. So it's a great way of getting a frictionless access to these products. Naturally, after they list, we'll be making a market, so you can go and buy them just like any other share on the JSE. So you can start putting your applications through. The EasyEquity guys said that they'll be sending around a mailer specific to those applications a bit later this afternoon, and it should be really simple to do. You'll just participate for a rand amount to invest into these funds. Another important thing to note is, unlike a lot of initial IPOs or initial public offerings like this one is, you'll get your full allocation. So if you subscribe for 10,000 Rand or 1,000 Rand, you will get that full allocation. Because it's an open-ended fund, we're not restricted in terms of taking on any cash. Once we've collected the cash, we then go and invest it offshore, and exactly how we've invested it, we create a Rand value of each security or each ETF, and we issue that Rand value into your account based on your Rand subscription. So there's some of the details, the share codes, the ISINs, management fees. As I mentioned, both of them, we expect the total expense ratio to become between 0.55% and 0.65%. We have made an undertaking to the market to say that if that TER starts creeping above 0.65%, we will knock it down and we will subsidize the fees and make sure that TER doesn't exceed 0.65%. And we are able to do that because we are taking the management fee out for our own account. So we can control that cost level. So that's really it. There's some general inquiries. If you like, please drop us a mail at info@Coreshares or call us on that number over there. Greenrock Securities is going to be making a market in this once it lists. So in other words, they'll be doing the buying and selling of these ETFs. But for now, let's take some questions. I've got time to take questions. So if you could please put your questions in that question bar, and I'll try and go through them one by one. Okay, excuse me, we're just trying to go through some of the questions. the first question we've got is, what is the main difference between S&P 500 ETF and DBX US? Okay, good question. They are, and in principle, they're very similar products. DBX US is also an ETF, so again, no credit risk to Deutsche Bank. I know there's been a lot of noise in the market about Deutsche Bank, but that has nothing to do with your ETF. The DBX US tracks a slightly different index. It tracks the MSCI US index, but again, it's a very similar index. The key differentiator for you as a client is that this ETF is going to come in between 20 and 30 basis points, or 0.2 and 0.3% cheaper. So that's really the main difference. It's a cost factor, and we launched the S&P 500 more generally because it's such a well-known index and people are so comfortable generally with the actual index. So that's really the only difference between us and the DBX US is at a cost front. And we think our cost is really competitive for the market at the moment. Okay, we're just having a look to see for a few more questions. Okay. Okay, so these ETFs will be available on tax-free savings accounts. So they qualify. Tax-free savings says that if there is an exchange-traded fund, which is also a collective investment scheme, that it qualifies for tax-free savings, and these are both they meet both of those criteria. So yes, they do qualify for tax-free savings accounts. And on EasyEquities, they should be available there. So we're going through a few more questions. That looks like, yeah, we've got a few more. The dividend distribution, there's a question, why is it not made on a quarterly basis? Most of our local ETFs we make quarterly. This is purely an administrative problem with these global ETFs, and you'll also notice that the DBX ETFs are only semi-annual. We only distribute semi-annually because it's a more expensive process, so it tends to be more efficient to only do so on a semi-annual basis. Got another question here that says, what is the advantage of getting in on the book build in terms of fees? The fees are identical in terms of the fund fee, so the TRs, if you invest via the book build, but the fees that you do miss out on if you participate in the book build, those are the brokerage fees that you would pay usually on your EasyEquities. So I know EasyEquities has really competitive and good brokers, but you would forgo those if you participate in the book build. So it's really just a small saving on the upfront cost of investing. Okay, we've got some more questions coming through. What startup amounts are you looking for in the two products? These are open-ended vehicles, which means we can list and delist shares as often as we like after the book build. So, we would be happy with really raising a good amount of money. We're sort of looking to raise about 100 million in each product. But again, if we don't raise it on day one, we can issue more securities on the exchange as often as we like. I guess you're wondering, well, what's the difference between that and a book build? The question is, there's not much. The big difference for you as retail investors is you generally can't participate in the ongoing book builds because they're for larger. We usually would only do that for amounts of, say, 5 to 10 million rand or more going forward because of the administration that surrounds the ongoing listings and delistings. Okay, we've got another question. So another tax-free, they certainly are qualify for tax-free. I think that wraps up all the questions. If you've got any questions, any more questions? Okay, we've got a very important question. Is the management fee part of the TER? Yes, it absolutely is. So our management fee is the largest component of the TER. The TER includes all costs for running that fund. So there's nothing over and above that, except, of course, when you're buying the ETFs, you'll pay brokerage because it's listed on the JSE. But yes, the management fee is definitely included in the TER. TER stands for total expense ratio, which means it's all of the costs, including management fee. So yes. And that looks like it from all the questions. So again, thanks to EasyEquities for hosting us today on this webinar. And thanks to all the participants for dialing in and listening to what we have to say. If you have any questions, please pop us or EasyEquities a mail. Contact details are at the end of the presentation. Or just drop an email to info@coreshares.co.za, and we'll respond to all of your questions. So thanks a lot again, and have a great afternoon.